To summarize, despite several production and delivery issues, the Model Y became the best-selling vehicle overall in Europe and the best-selling non-pickup vehicle in the US in Q1 of this year. The Tesla team deserves enormous praise for these outstanding performance. Hello everyone, we're here to discuss one of the most talked about subjects in the stock market right now. Tesla's incredible first quarter profits. Yes, you heard correctly. Tesla is in flames. And no, I'm not just referring to their electric cars. The company recently released its first quarter 2023 earnings report, and the results are pretty interesting. That really indicates where our portfolio should go. So let's not wait any longer and jump right in. As everyone knows, the pandemic's aftereffects are still felt in the economy. Tesla is not exempt from it. Let's now look at the data to see how the company is responding to the problem. Interestingly, they have been cutting the pricing of their vehicles, and this is finally reflected on their financial accounts. The most intriguing finding for this quarter is Tesla's operating income. And surprise, there are some unhappy numbers on the graph. With China shutting down last year, Tesla's gross profit took a hit, falling from $5.5 billion in the first quarter of last year to $4.5 billion this year. This is a year-over-year reduction in gross profit that we haven't seen in a long time. Tesla actually saw growth, but this year's price drops are really having an effect on their profitability. According to earnings reports, they made a whopping $2.7 billion in operating income, which is slightly less than in quarter 2022 and the lowest in a while. You might be wondering, if this is less than before, why are we so excited? Well, let me tell you that it all comes down to Tesla's gross profit and profitability going forward. After all, the company's current valuation is based on the fact that it is a massive growth company. If Tesla is able to consistently generate $5 billion in earnings per quarter, that's $20 billion in earnings for the year, and a 25 times price to EBIT ratio that justifies a $500 billion valuation. However, here's the thing. Since Mark will be a little harder to work with this year, Tesla's Score 1 earnings report is helpful. Although operating income may be little lower than in the past, their gross profit and profitability are still looking rather good, which is particularly significant because it implies that Tesla is still growing and expanding, even though they might not reach the $20 billion milestone this year. In addition, the company continuously innovates and introduces new products, which only increases its potential for growth and profitability. Tesla's first quarter revenue of $23.3 billion is astounding. But even more impressive is their operating income of 19.3%, the lowest in the company's history. Keep in mind, however, that doesn't even account for all of the price declines that happened in the second quarter, so we might see these numbers drop even further. While Tesla's business model enables them to profit from every additional $1,000 for FSD, they only make between $5,000 and $15,000 per car, so even a decrease of $1,000 to $3,000 can have a significant impact on their margins, which in turn affects their income statement. It's like a never-ending cycle of financial jargon. But here's what I find really fascinating. It's as though we're watching a real-time economic case study unfold right before our eyes. Initially, I thought Tesla would be able to withstand these price cuts, with earnings remaining unchanged for a while. But now that I'm beginning to suspect earnings may actually begin to decline when I look at Tesla's operating income on an annual basis minus $12.6 billion, which is impressive. And with quarter one's earnings with uncertain earnings growth, it becomes more difficult for investors to justify Tesla's $1 trillion or $500 billion market cap. Nevertheless, let's set all of those numbers aside for a moment. Last year, Tesla's energy business set a record-breaking revenue of $1.3 billion. But this year, they surpassed themselves with a whopping $1.5 billion. How did they do it? With the incredible growth in their Megapack business. They've been deploying batteries like crazy, hitting 3.9 gigawatt-hours, and recently opened a new mega factory in Shanghai, which will only accelerate that growth. We're all in this for the long haul, so as shareholders, we should be mindful of the recent price cuts. While deliveries are increasing by 30% and revenue is up by 20%, we are seeing a shrinkage in EBITDA and gross profit. If these price cuts continue, earnings growth may not materialize, which could be concerning for a growth stock like Tesla. Don't worry though, I still believe in Tesla's long-term vision. Alright, let's get real first. While Tesla's first quarter results may appear a little sluggish, it's important to remember that they are the industry leader in terms of profitability and strength, which is terrible news for rivals like Rivian and Lucid. I apologize, But I'm not really sorry. After all, Tesla has enough of cash to get through this, so they should be alright in the long run. In the long run, though, it's interesting to note that earnings could decline or stagnate during this recession, which would impact such a strong growth story. Let's not focus on the negative, though, as there are a lot of positives to discuss, like how Tesla's energy business is booming and how its Megapack business is leading the way. And let's not forget about their amazing electric cars, which are revolutionizing the auto industry as more and more people switch to electric vehicles every day. If none of that placate you, though, you should wait a while to see what Musk plans to release in the coming months. If the news doesn't satisfy you, I predict that the charts will spike dramatically. Yes, you heard correctly. Elon Musk stated during the third quarter of Tesla's earnings call that the next generation platform will only cost half as much to produce as the current Model 3Y platform. Given how successful the current Model 3 models have been, just think of what Tesla can accomplish with this platform that is even less expensive to produce. Now let me be clear. This does not mean that the new platform will exactly half the price of the Model 3. Rather, it means that the price will be significantly lower, making it more affordable for a wider audience. After all, who wouldn't want a Tesla at a lower price point? However, it's not just about the price. The next generation platform will also represent a significant advancement for Tesla in terms of production. Elon Musk asserted that this platform's output quantities will exceed even the coming back to what we have now. I know some of you may be concerned about Tesla's valuation dropping to more reasonable levels. However, with the release of the Model 3 and Y, which is a huge accomplishment in and of itself, we can expect to see more Tesla vehicles on the roads and hopefully a decrease in wait times. There's no denying that there is some economic uncertainty in the world, and that can have an impact on the stock market. But you shouldn't worry. Even with the bearish technical pattern, Tesla is still a stock that investors should keep an eye on. The kicker at lower levels is that Tesla is a mature business that needs to be watched closely. However, as we've already stated, this would rely on the ability of all manufacturers to secure sufficient battery materials to meet the demand for the electric vans to be produced on a wide scale. If you're looking for a Tesla that has a bit more room for passengers than regular sedans, you're in luck. There are 2 SUVs from Tesla that can accommodate more than 5 passengers. We can't give the company a perfect score, because we have to admit that the company is starting to see a slowing growth. However, in actuality, Tesla is a lot superior financial decision. Thus, if you're considering investing in Tesla, this might be the ideal time to do it. In any case, please share your thoughts about the most recent earnings call with us, and let's continue the conversation. We'll talk about this when we get together for another episode split. The first quarter saw EV's gross profit margin fall below 20%, the lowest level since the end of 2020, as a result of significant markdowns. What does Tesla's most recent earnings report teach us then? Basically, it tells us that continuing to lower car pricing results in losses.